My name is Dennis Silvia, and I'm with Cedar Consulting, a part of the USA Risk Group. And today, my guest is Kevin Doherty from Burr Forman. He's the head of Burr Forman's captive insurance group. Welcome.
Thanks, Dennis. Good to see you.
Thank you. You know, we have a lot of questions typically from clients oriented around kind of the alphabet soup of captive insurance. And so often people are throwing out things like, what's an 831B, and what about this, and what about that? And I was hoping that in asking you some questions today, we'd be able to get to the bottom of that.
Absolutely.
In particular, when we talk about 831B, just what exactly is 831B?
Well, 831B is a code, a section in the Internal Revenue Code that it deals with insurance taxation, and it provides a very useful opportunity for people to have an insurance company that is essentially free from taxation on its underwriting income. So for an insurance company, that is a very useful tool, and today it would still pay tax on its investment income. But as you know, today investment income is very limited in our current market. That's right. The good news and the bad news is sometimes it's a good thing to pay taxes. It means you're making money. But the 831Bs have been very popular in the captive world because of the tax opportunities and advantages, as long as you stay within the scope of what 831B allows, which is only premiums up to $1.2 million per year.
Any restrictions on the kind of business that you put into it?
Not really, as long as it goes back to what is overall described as insurance. And the Internal Revenue Code, as you know, does not specifically say or define what insurance is, but there are a whole series of case law over the last 40, 50 years that have defined what insurance is, and essentially your company has to be a true insurance company. It has to actually transfer risk and shift risk and distribute risk. And it has to comply with what's known as the actuarial law of large numbers. So, and you have to treat it like an insurance company. You can't have a company where you pay premiums to get the tax advantage but never pay a claim, for example. It has to look, smell, and it has to walk like an insurance company.
Okay.
And then if you do that and stay below $1.2 million, you get the advantage that 831B gives you.
Now, I want to talk a little bit more in a minute about risk distribution, risk transfer. But in particular, when we say tax-free, I think lots of times people who own these companies think it's tax-free to them. It's really tax-free to the captive, isn't it?
Correct. If you make an investment in any company, and whatever taxes that company pays or doesn't pay, when you have gain and when that company is worth more than it used to be, and you capitalize on that gain and draw that money back, you will pay taxes on the gain. So it's like any other investment, it's no different.
So the advantage there might be that the taxes that you pay on the gain might be taxed at a different rate than regular income might be taxed.
You might be able to take advantage of dividend style or capital gains type treatment.
Now,
correct.
Kevin, what if I was in a situation where I owned one of these companies and I did business in it for 4 or 5 years and took advantage of that, the no taxation on the underwriting income in the captive, and then I stopped writing business for 2 or 3 years. Does that money that's in the captive become taxable immediately as a result of that? Or
no, as long as it stays in the captive, it still takes advantage of the tax status of the captive.
So even though I'm not actively doing business, it would still be tax deferred to me.
Just like if you bought stock and you kept that stock for 50 years, you pay tax when you sell it.
Okay, good.
There's no recognizable gain event until there's a transfer of the gain.
Now, let's touch on risk distribution and risk transfer. When we use those terms, I mean, that's kind of the holy grail, isn't it, really, of insurance?
Absolutely. Risk transfer means you have to actually literally transfer the risk from one company to another, so a different entity, but that's not sufficient. You also have to have a distribution of risk such that it's truly insurance. In other words, it'd be like a lot of people buying, 20 people buying into something that might only happen to one of them, but they're all sharing in that risk. And there are IRS standards and there are IRS safeguards into how risk is defined as being fully distributed. There are essentially 2 ways to distribute the risk. You can either have a situation where you've got a brother-sister arrangement and there's sufficient numbers of entities involved and sufficient premiums that are shifting among members, or you can have an entity that has sufficient third-party business. In a brother-sister arrangement, you could have a single parent with maybe a dozen or more subsidiaries, and you add another subsidiary, which is the insurance company, which then provides insurance to the other companies that are already existing. And as long as there's enough of those companies, and there's an IRS ruling that gives us a safe harbor on that, then if you meet that standard, you achieve tax treatment. The other way is a sufficient unrelated risk. So if you have a company and you have at least, according to case law, the number that most people have used in the industry is 30%. If you have at least 30% unrelated business, in other words, third party, you're writing coverage for somebody based on your premium and your risk, that's at least 30% of your book of business that has nothing to do with you or any affiliated company, then you achieve tax treatment as an insurance company. The IRS safe harbor in that area is 50%. So based on case law, there's good reason to think that you could win a case based on 30%, but if you have a particularly conservative client who's very leery of doing anything outside the scope of what the IRS specifically approves, then it would be 50%.
And the brother-sister, the case law there is the Humana case?
Humana case is the defining case in brother-sister. Basically, Humana had a series of subsidiary corporations, hospitals, and they established an additional company to provide insurance for those hospitals. As long as the insurance company was not providing insurance to the parent, that would not be considered kosher from a insurance tax treatment. But if it's providing coverage to the other companies, then that's, as long as there are enough of them, then that achieves insurance tax treatment.
Okay, good. And employee benefits from a business, that's considered a third-party liability for these purposes?
For the most part it is, generally speaking. If you have usually employee benefits is in the context of a very large corporation, and the third parties are the employees essentially. So the corporation's not really providing benefits for itself or its subsidiaries, it's providing insurance for the employees. And generally speaking, that's considered third-party business.
Okay. Well, thank you. Really opened that up a little bit, and I'm sure that folks who watch this are going to be enlightened by the information.
Great. And I thank you for letting me come on and talk to you.
Appreciate it. Thank you.
Thanks, Dennis.